If you're new to investing and you don't know where to start, today I'll be going over top 5 ETFs that I personally like to invest in and that I plan to hold for the long term for growth and for capital gains. Hi guys, welcome back to my channel. My name is Gabrielle, and for those who are new to my channel, I am a CPA and tax manager at one of the big 4 accounting firms. And here on my channel, I like to talk about everything money and career. And today I have a very exciting video for you guys because I'll be going over top 5 ETFs that I hold and that I invest in for growth. If you're new to investing and you haven't really found the right brokerage or platform for you, I personally like to use Wealthsimple or QUESTRADE. Wealthsimple is great for those who are beginners because the app is very user-friendly, and the best thing is that there is no commission or fees when you trade stocks or ETFs. So feel free to check out that app. I'll link it below and you could get 2 free stocks using my link. If you consider yourself more intermediate as an investor, then I personally like to use QUESTRADE, which has a lot more options and you could do a lot more fancy things on it. I also have a link down below for you guys to check out for extra free money. Also, before we start, I just wanted to let you guys know that I am not a financial advisor and everything I talk about in this video is just for informational purposes only and not financial advice. I strongly recommend that you do your own research before you invest your own money. So without further ado, let's get started on top 5 ETFs that I like to invest in for growth and capital gains in the long term. And if you guys stay until the very end, then I also have a bonus ETF for those who are more risk averse and lazy and just want to hold one ETF instead of worrying about all these different types of ETFs. So let's get started. The very first ETF that I have for you guys is the XIU.TO, which you could find on the Toronto Stock Exchange, and it stands for iShares S&P TSX 60 Index ETF. And this one primarily focuses on the Canadian market and the top Canadian companies. Let's start off with the price. You can see that it's Canadian dollars $32, which is very reasonable, is a very good entry point. And if we're moving along here for the returns, the 1-year return is 28%, which has done really well. But I would say it's a little bit of an outlier because if you look at the historical data, the 3-year average is 11.56, which is still pretty good. But keep in mind that historical data does not represent how it will do in the future. So this is just a reference point only. If we look at the calendar year for its returns, 2020, it still did decent at 5.45% despite it being during the pandemic. And 2019 was a very good year with 21.72%. And in 2018, it didn't do so well with a negative return of 7.72%. So it's just important to keep in mind that these index funds or these ETFs don't do well and they don't just go up every single year. There are going to be years where it's going to have some negative returns, but if you look at the long term and if you hold it for the long term, then overall on average, it has made positive returns. So that is really important to keep in mind. Now moving along here, the inception date of this ETF is 1999, which explains why you could see a lot of historical data including up to 10 years. Even the 10-year here is 9.21%, which is pretty good. It definitely beats inflation, which historically has been around 2%. And that is why it's better to be investing in the stock market than just holding it in your bank account, because bank accounts nowadays don't provide you with enough interest rate or high enough interest rate to beat inflation. So these are sort of other alternative investments that you should consider in terms of where to put your money. So moving along here, we will be briefly talking about some financial ratios. I won't be going into too much in depth, but I do want to go over them with you guys so you kind of know what to look out for. Keep in mind, we're looking at many stocks in this one basket of ETF and not a single stock. The main 2 ratios that I like to look at is the PB ratio and the PE ratio. PB ratio stands for price to book ratio, and it basically tells you what the market value is compared to the book value of the companies. And according to Investopedia, a good reference point here is traditionally any value under 1 is considered a really good PB value, which indicates a potentially undervalued stock. However, value investors also consider stocks with PB value under 3 to be pretty good. So if it's within that range, then it's considered to be pretty good. And if we're going back to this ETF, the ratio is 2.43%. So we would say it's within the range and it's relatively healthy. Now looking onto the PE ratio, which I would say is more often looked at, it's the price over earnings ratio, so the market value over its earnings. And for this one, it's mostly focused on the income statement. And if we're also looking at Investopedia, and what a good reference point is. So the biggest index fund is probably the S&P 500, and that could be a good benchmark. And they have historically ranged from 13 to 15. I don't know how accurate that is because when I kind of did my own research, it seemed like it was more in the 16 range. And that is considering like all the way back to the 1800s. If you just look at the past 20 years alone, then the range is around 25. And the PE ratios really depend on the industry and sector. And in our case, since we're looking at index funds or ETFs that have multiple stocks in one basket, it's sort of difficult to just get an average and see what is a good reference point. So for example, certain technology companies might have a really high PE ratio compared to utility companies, which are a lot more stable and they tend to have lower PE ratios. And even it states in the Investopedia here, however, companies that grow faster than average typically have higher PEs, such as technology companies, and a higher PE ratio shows that investors are willing to pay a higher price today because of growth expectations in the future. And here it says like the average PE for S&P has been 13 to 15. As I mentioned, I don't know how accurate that is. I would say it has been more like 25 in the past 20 years, which is a better reference point. And for example, a company with a current PE of 25 trades at 25 times earnings, and the high multiple indicates that investors expect higher growth from the company compared to the overall market. And a high PE does not necessarily mean a stock is overvalued. Any PE ratios need to be considered against the backdrop of the PE for the company's industry. So that is sort of what a PE ratio looks at in a nutshell. On another note, if you guys read Intelligent Investor by Benjamin Graham, which is a really popular book for those who are into investing or more value investing. And keep in mind, this is a very conservative number, but their recommended sort of PE ratio is between 12 to 15. That's pretty conservative and is really, I would say it's a little bit harder to come across those ratios nowadays. And in reference to that, if you look at this ETF, the PE ratio is 22.07. And I would say this is on the lower end compared to all the other ETFs that we'll be looking at today. And also keep in mind that 2021 was sort of like a really crazy year where a lot of these index funds did extremely well. And it could mean that the whole stock market is a little bit overvalued, or maybe it just means there is a big potential in the future because of the reopenings and all that. So that is really something that nobody knows and nobody really could predict what the market is going to do. So something that I like to do to offset whatever the market is doing is dollar cost averaging. So every month I like to put in a little bit of money towards these ETFs to sort of average out the price that I buy them in. So certain months I might pay an expensive price for it, and certain months I might pay a relatively low price for it. And in the end, instead of trying to time the market and get the lowest price for these ETFs, just kind of automate it and invest consistently. And that in itself is much better than not investing at all and being scared that you are overpaying for your investments. Moving along here, if we are looking at dividend yields, that's not going to be the main focus of these ETFs. They're more for growth. 12-month trailing yield is 2.49%, which is actually decent because the Canadian ETFs tend to have a lot of financial and utility companies which pay dividends more often than US market ETFs that we'll be looking at. So just keep that in mind. So 2.49% is actually pretty decent, and it's going to be the highest among the group of ETFs that I'll be mentioning today. Now, moving along here, we will be looking at management fees. This is also something that I like to look at because at the end of the day, the returns that you'll be getting will be net of these expenses, which include management fees. And in this case, the management fee is 0.15%, which is, I would say, relatively low for a Canadian ETF, and it's much lower than what you would be charged for mutual funds at a bank, which can charge anywhere from 1 to 2%. So moving along here, if we are to look at what the top holdings are for this ETF, the top holding here, as we can see, is Shopify, which has 8% weight, followed by a bunch of financials. So a lot of banks, as you can see, RBC, TD, and then some energy like Enbridge and TC Energy Corp. And even here in the exposure breakdown, you can see that 36% is in financials, followed by energy, IT, industrials, materials, and etc. So that is the first ETF. And if we are to move on to the second ETF that I have for you guys, it is XQQQ, which stands for iShares NASDAQ 100 Index ETF. And this is Canadian hedge because the underlying ETF is a USD one, and we want to pay in Canadian dollars because we're in Canada. And what the Canadian hedge does is basically you get your returns closer to the original benchmark index instead of having your returns affected by the foreign exchange rates between Canada and the US. I always like to have Canadian hedge ETFs if I want to invest in the US market. The price is Canadian dollars $123, and I think that's a pretty good deal considering that NASDAQ index funds are pretty expensive. And if we are to look at the performance, the total return is 28.55% in the past year, and the 3-year average is 23.31%. The NASDAQ index fund in general did pretty well in the past couple of years. Even the 10-year is 21.38% because technology has been booming and it has been doing really, really well in the past decade. So that explains the higher returns. If we look at the calendar year, the 2020 alone is 45%. So that's a pretty good number. And that is because during the pandemic, a lot of companies had to rely on these IT companies to function and to do business, which explains the higher returns. Even in 2019, it did pretty well at 36%. And then 2018, which was not a very good year for the stock market, it actually didn't do so badly. It only did negative 1.75%. Now, if we are to look at the PB ratio, it is 9.10, which is a lot higher than our 3 reference points. And that is because, like I said, these ratios really heavily depend on the sector and the industry. And because the NASDAQ 100 is more skewed towards IT companies, these ratios are going to be a lot higher. And even the PE ratio is 43.34%, which is, almost double what we saw for the XIU ETF. So just keep that in mind. It could be of 2 things. It could be maybe it is a little bit overvalued, or that investors just see a lot of growth potential in the future. The management fees are 0.35%, which is slightly on the higher end, but do keep in mind that this is Canadian hedge. So a little bit more work is required in order to hedge against the foreign exchange, and which explains the higher management fees. Now, if we're looking at the holdings, the top 10 is mostly IT, and they're all big names that we all know, like Apple, Microsoft, Amazon, Tesla, and Alphabet. Alphabet being the shareholder of Google, so really big companies. And here the exposure breakdowns are mainly information technology, which is 47.6%, followed by communication, consumer discretionary, and healthcare, and etc. The third ETF that I have for you guys is XSP, and this stands for the iShares Core S&P 500 Index ETF. This is also Canadian hedge, and the price in Canadian dollars is $49.50. This is sort of the main index fund that everyone likes to invest in because it is consisting of the top 500 companies in the US. They are large cap companies, so they seem to be more stable. Overall, in the long term, they are shown to have positive returns over the long run. We will just be looking at the returns here now. So the last 1 year, they did really well at 29%, the 3-year being 13.94%, and the 5 and 10 years did even better at 15% and 15.46%. So they've done really well. In the calendar year for 2020, they did 15%. 2019, they did 29%, which was a really good year. And then 2018, it wasn't a very good year for the stock market. They did 6.15%. So there's no ratio here. So what we're going to do is we're going to look at the main ETF. This one is the Canadian hedge, but if you actually look at the holdings, they hold 97.47% in this ETF called IVV, iShares Core S&P 500 ETF. And this one is the USD one, and it's much more expensive. It's $460 USD. The good thing about this ETF is that it more closely follows the benchmark of the S&P 500. So your returns are going to be slightly better. And also the expense ratio is a lot lower. It's only 0.03%. But the downside is it is USD. It is a lot more expensive. So if that's something that you're interested in, you could go ahead and invest in this one. But I personally like to invest in this particular ETF because it's a lot more affordable, and most of my earnings are in Canadian dollars, so this is something I like to invest in. If we are looking at the ratio here for the PB ratio, it is 4.94%. It's actually higher than our 3 reference point. And I know historically for the S&P 500, the PB ratio for the past 20 years has been around 2.9. So the current year for the PB ratio is actually quite a bit higher. And then the PE ratio here is 34.30. Now keep in mind that historically the S&P 500, the PE ratio was around the 16 mark. And then in the past 20 years, it was around 25. So this year's PE ratio alone is quite a bit higher than what the S&P 500 is used to. Now, if we're looking at the dividend yield, obviously, we're not really investing in these ETFs for dividends, but you do get something. It is 1%, which is better than nothing, but it is pretty low. And here, compared to the core one in USD, which was 0.03%, here it is 0.09%, which is still pretty, I would consider it on the low end compared to other Canadian dollar ETFs. If you look at the holdings, like I mentioned, it is mainly holding the main ETF here. And so I'll just jump over here to see what this ETF holds. You can see that the main or the biggest weight goes to Microsoft, Apple, Amazon, Alphabet, Tesla, Facebook. So you'll see that there is a bit of an overlap between this ETF and the NASDAQ one, a lot of it being the IT companies that you get exposure to. So maybe you want to invest in one ETF over the other, or if you really do believe in IT, you might want to invest in both. It is really up to you. And even in the breakdown here, you can see IT holds 27%. So it's not as big as the other NASDAQ one, but it does still have a pretty big holding in IT sector, followed by healthcare, consumer discretionary, financial, communication, industrials, and etc. The fourth ETF that I have for you guys is XSMH. And this one is for the iShares S&P US Small Cap Index ETF. And this is different from the other one because the S&P 500 mainly focuses on large cap big companies. This one focuses on smaller companies in the US of around 600 companies. Looking at the price, it is $28.98, which is a really good entry point. And this is in Canadian dollars. The returns to date has been 56%. This year has been a really good year for small caps. You can't really see what the historical data is because it was this ETF was created pretty recently in 2019. The thing with these small cap ETFs or small cap indexes is that it could do extremely well or it could do extremely poorly, and the volatility is a lot greater than the other ETFs just because this is higher risk, higher reward kind of situation. Now, if we're looking at the PB ratio, it is 2.21, which is under our 3 reference point, and it's actually better compared to the S&P 500, strangely. And then the PE ratio is 21.69%. So I would say that's a relatively healthy number. It is higher than the 15 reference point, which is more like the ideal reference point, but I would say this is healthier compared to the S&P and the NASDAQ ratios. Also, keep in mind that these ratios, they really differ depending on the sector. So depending on what sort of holdings this company has, this could be considered reasonable or not reasonable. The distribution yield is pretty abysmal at 0.51%. And here the recent distribution is 2.03%. Maybe they had a dividend payment recently, so there has been a bit of a jump, but generally with these ETFs, you don't really expect much of a dividend payout. Now here for fees, it is 0.22%. And then keep in mind, it is slightly higher. And I would say the higher management fee is due to the Canadian hedged component because a little bit more work is involved to hedge against the FX fluctuations. Similarly, this one also holds 97% in the main ETF, which is iShares Core S&P Small Cap ETF. This one is in USD dollars, is $113, so higher than the other one. Also, the ratio is 0.06%, so a lot lower. So if you prefer to pay, lower expense ratio and you don't mind paying in USD, then investing in this ETF is also a great alternative. But we are here to look at the main holdings. It's kind of all over the place. You can see Macy's, Omnicell, Chart Industries. So a lot of these companies are not as well known because there are smaller companies. But if we were to look at the exposure breakdown, we'll see that, there's financials, industrials, information technology, consumer discretionary, healthcare, real estate. So a bit more diversification than the other ETFs, which mainly focus on IT. Last ETF that I have for you guys is the IEMG, iShares Core MSCI Emerging Markets ETF. Now, this one is in USD of $63. And the reason why I chose this one over the Canadian equivalent, which I will show you guys here, this is the Canadian equivalent of XEC, and it's a bit lower. The reason why I chose this USD one is because this other Canadian one is not Canadian hedge. So there is a bit of a difference when it comes to the returns. And I don't want to, leave the returns up to the foreign exchange fluctuations. I prefer to have the USD one just because it's not too expensive compared to the other ETFs that we saw, where the equivalent was a couple hundreds of dollars. This one is $63. So it was sort of within my range. And also the expense ratio is a lot lower than the other one. Here you'll see it's 0.11%. If you look at this one, the Canadian dollar one, it is a lot higher at 0.25%. And so that is a reason why I'm going with the USD one, and this is the one that I'm investing in. Now, if we're looking at the returns, we'll see the 1 year is 19.95%, so around 20%. And then the 3 year is 8.82%. 5 year being better at 9.16%. The calendar year, 2020 was a really good year at 18.18%. And then followed by 2019, which did kind of similarly. And then 2018 wasn't a very good year at negative 14.69% return. You'll see that 2017 was a particularly good year at 36.78%. The main index that this ETF benchmarks against is the emerging markets one. And emerging markets is a completely different market compared to the ETFs that we've looked at, which were mainly in North America. So Canadian market and US market. The reason why I chose this ETF is because I want to have exposure to potential growth markets like Korea, China, Taiwan, Brazil, and while they are not as established, and so there might be a lot more volatility in the prices, and there are greater chance of certain years having negative returns, but I would say there is quite a bit of upside to these markets because they are still, as the name suggests, emerging and they're still developing, and so we don't quite know what the future holds. But if there is some really good breakthrough, then these stocks will do really, really well. And I am willing to take on that risk. So it's really up to you whether this is a market that you want to invest in, because it could be considered quite volatile and more risky compared to the other ETFs that we were looking at. Now, if we're looking at the ratios really quickly, the PB ratio is 2.05, which is relatively low. It is under the 3 benchmark that we looked at. And the PE ratio is 18.89%, which is the lowest out of the group that we've seen so far. I don't quite know why it's a little bit lower because I haven't looked at the details of all the different companies, but just by looking at this, it seems like they have healthier balance sheets. But who's to say that there is some other factors that haven't been considered? The 12-month trailing yield is 1.93%. So the dividend yield is actually, pretty high compared to the other ETFs that we looked at. Now, looking at the fees are also on the low end at 0.11%. If we are looking at the top holdings, the first here, the biggest weight of 5.76% is Taiwan Semiconductor Manufacturing, and they're huge. This company is huge for chips, and I know that we are currently going through a chip shortage. Tencent Holdings, Alibaba is huge, even though lately they've had a bit of a drop in their prices. Also, another big company is Samsung. So a lot of your electronics that you see around the house could be Samsung electronics, like your monitor, your refrigerator, your washer and dryer, etc. If we're looking at the exposure breakdowns, you'll see that 20% is in IT, followed by financials, consumer discretionary. Now, I have a bonus ETF for you guys, and this is for those who are more risk averse and they don't want to see as much fluctuations in the returns, but at the same time, they don't get the upside compared to some of these other ETFs that we mentioned, because obviously, lower risk, lower returns, high risk, high returns. Also, this ETF is for those who are kind of lazy to keep track of all these ETFs, because this one is a balanced ETF which has holdings in various other ETFs. So the ETF that I have for you guys is the XBAL, and this one stands for iShares Core Balanced ETF Portfolio. This one is currently $27.41. And you'll see here, if we look at the performance, it is 13.28%. So you can see that is a bit lower than all the other ETFs that we mentioned, but you'll see that the returns are more consistent if we look at the calendar year. So 11%, 15%. The 2018, you could see that there was less of a drop at 2.51%, and then followed by 5% in 2017. So like I mentioned, not as big of an upside, but your returns are a little bit more consistent. And that is because if you are to look at the holdings here, it's because around 63% is in equity and 36.63% is in fixed income. And fixed income could consist of various things, but most of its holdings here, if we look at it, are bonds. But you do get some exposure because around 63% is in equity, and this equity component consists of various other ETFs like the S&P Total US Stock. So this is a US market. There is also the Canadian market with the S&P TSX. This one is 16%. And then there is a bit of the European market. These are more developed countries. This one is 15%. So you'll see that you do get a really good, and then there's also here emerging markets, which is the only 2.8%. So you do get really good diversification with this one, and it's good for those who are, lazy and don't want to do all that much research, and they just want to invest in one ETF, but at the same time, you don't get that upside. So just take that into consideration when you guys do choose your investments. That was a very long video today, and if you guys appreciated all the research and work that went into making this video, then I would really appreciate it if you guys could hit the like button down below, as well as subscribe and hit the notification button so that you guys can be updated on more of these investment related videos in the future. If you guys enjoy watching these sort of videos, then I will also link other similar investment related videos here for you guys to check out. I'm sure you guys will also find them pretty useful. If you guys watch until the very end, thank you so much for watching my video today, and I'll see you guys in my next one. Bye!